Hey, if you're looking to start a Montessori school and you need a set of financial projections because maybe you are trying to get a loan from the bank or raise money from investors to help cover the startup costs, and they've asked you for a set of financial projections, well, then you've come to the right place because we have built a financial projection template built specifically for private schools, and in this case, a Montessori school. Now, we have filled out this template, this private school template, specifically for the use case of a Montessori school, and I'm going to walk you through how to fill it out, how to read the results once you're done and what they mean, and then also show you what you'll need to provide to your lender or investor. But before I dive too far into that, my name's Adam Huxema. I'm the co-founder of Projection Hub, and over the last decade, we've helped over 50,000 entrepreneurs create financial projections for potential investors and lenders in all sorts of different businesses and industries. But today, we're focused on this Montessori school template, and I'm going to walk you through that here in just a minute. There is a link to this template in the description of the video below. So it'll take you to our private school template landing page where you can purchase the template. When you purchase it, you'll be sent a couple different variations of the template. So kind of a generic private school template, but also a Montessori specific filled out version of the template, which is what I'm talking through today. Also, if you stick around to the end of the video, I'm going to give you access to a coupon code that you'll be able to utilize as a thank you for sticking around. So that's to come. All right, with that, let's go ahead and dive in. Okay, so we are kind of starting here with the end in mind. This is the at a glance tab. After we filled out all of our revenue and expense assumptions and startup expenses and loans and investments, all of that, this is where you're going to kind of see the end result. And so you'll see a profit and loss at a glance tab, some summary data, some different charts and graphs. You can see with the school, cash flow and sales are kind of lumpy, right? If you're off during the summer, then you might have a couple months without cash flow. So you get to kind of see and visualize that. And also kind of a breakdown of how you would use your startup funds. You'll also get a 5-year income statement summary, a 5-year cash flow summary, 5-year balance sheet summary, and then you get your income statement, cash flow, and balance sheet statements all broken down by month, so you can see that monthly level detail as well. All right, but in order to produce all these reports, we have a little bit of work to do. So I'm going to walk you through the input tabs here. So we're going to start in the input assumptions tab. And the first thing you need to know is that any cell that's highlighted in light blue is an assumption cell that you can change without breaking something in the model. So we've got a Montessori school starting in January of 2023. We are assuming that you're putting in a personal investment of $75,000 here. And we have assumed a budget for remodeling our space of $336,000, $50,000 for furniture and fixtures, $50,000 for kitchen equipment, $50,000 for computers and tech equipment, and then $10,000 for a security system. And these are kind of our fixed asset startup costs. Now, we're also going to assume that we're taking out a loan, a $700,000 loan, paid back over 10 years at 8% interest to help cover these startup costs as well as provide some working capital for those first few months. All right, now let's jump over to our input revenue tab. So to start with, what you will be able to do is just enter in your different age groups that you'll be providing school to, right? So we're kind of grouping this. We're assuming that preschool age 3 to 6 will be together in one classroom. And then you'll have 2 classrooms with, in the example we're going to see here, 2 elementary school classrooms of 30 children each in that 6 to 12. I think we have it set up as 1 age 6 to 9 and 1 age 9 to 12. Here you can enter in your average annual increase in tuition and fees and annual increase in supplies costs. All right, now the payment structure that the parents or the students are paying for the students really matters a lot for a school, and it really can impact your cash flow because you're probably going to get people paying all up front, and then you got to make sure that cash lasts through the end of the year, right, to pay your ongoing expenses. And so there's a whole bunch of kind of payment assumptions that we need to kind of get set up. So that's what this section is. So the first thing we need to do is we need to say, what calendar month is the school year or the term going to start? And so we've got that set up as month 8, which would be August, right? The 8th month of the year. And we say the last calendar month of the school year is May, month 5. So that's then calculating that, hey, there's going to be 10 months of programming of school going on, right? Now, the first payment of the school year is for those that are paying monthly. We've got a typo there, monthly. So the first payment of the school year for those that are paying monthly would be month 8. So you can see this says enter the month that students are required to make the first payment if they are paying monthly. So we're going to go through options where the students have the ability, or the parents have the ability to pay monthly, on a semester by semester basis, or annually. And you might have different prices that you want to offer. Like you might give a discount if someone is willing to pay for the whole year up front, right? So we need to set up those assumptions here about the timing of when those payments will come in. So if we're paying monthly, we're assuming it starts on month 8 and ends on month 5. Now, if you have people that are paying by the semester, we assume they pay the first semester by month 8, and they're paying for the second semester in month 2, in other words, February. And then if they are paying annually, we are assuming that they'll pay the whole year upfront in month 8 or in August. And then your book or supply revenue. So this would be if parents are also paying the school for additional fees beyond tuition for books and supplies and that sort of thing. It might just be easier for you to just kind of ignore this piece and just like wrap this all into your tuition cost. I think that's what I'm going to do in this example. But you do have the ability to set assumptions there. All right, so now we have our 2 programs. We have preschool and elementary, both starting in month 8. So both programs are going to start in August. And we select the category here from the drop down. So it's preschool and elementary. And we're saying that there are going to be 30 students in the preschool age 3 to 6 class and 60 students in the elementary school. And this is the months to reach the average student level. So basically, if you are thinking it might take you time to reach kind of your capacity, let's say 30 is the capacity for the classroom. If you think it might take you 3 months to kind of reach that level, then you could put in month 3. But if you're hoping that everyone that is going to be enrolled is enrolled right away in month 1, then just put month 1. Now, we can say, okay, what percentage of our students are paying, of these preschool students are paying monthly? We're saying that 20% are paying monthly, and the monthly rate is $1,300 a month. So in this example, right up here, I said, okay, it's $13,000 for the year, and it's divided by 10. So for the 10 months of the program, they'll be paying $1,300 a month. And then 50% of our students, we're assuming, are going to pay by the semester. And so what I did here was I said, okay, we're going to give them a $1,000 discount if they pay by semester instead of by month. So now it's $12,000 divided by 2, so $6,000 a month, or $6,000 per semester. And that leaves the remaining 30% of students we're assuming then, are paying annually. And we're giving a further discount, another $1,000 discount if they pay annually. So the annual rate is $11,000. And then what we can do here is we're going to set the students per one instructor. So how many students can you have in a classroom per one instructor? And we're saying 30 for both. And that's going to help us calculate how many teachers are required. And then we're assuming that that the school, the business, the Montessori, is going to spend $250 for books and supplies for the year for the preschool, and $500 on books and supplies for the elementary. Now you have the ability here to say, we're going to actually charge the students for this. So, if you wanted to also charge the students additional fee, like a book or supply fee on top of tuition, you can add that here. But I'm just going to assume that's kind of built into the tuition here. Okay, so that's all the revenue assumptions that we need, and then that is going to help us calculate our revenue. Now you'll see that we don't have any revenue here in these first few months because we're assuming revenue doesn't start till month 8 of the model, so August. And you see in month 8, revenue starts to kick in. And then it ends at the end of the school year, and you have a couple months where you have no revenue, and then it kicks in again with the next school year. All right, so now let's look at our input other expenses tab. So you have the ability to add some different expense categories up here, and those categories will then populate these drop-down boxes here. So then you can put in your specific expenses. So we've got advertising, utilities, insurance, subscription, software, office supplies, maintenance and repairs, food for feeding the kids lunch if you're going to be doing that, cleaning the facility, accounting, and rent. We've got those all categorized. And then you can select here what month. Let me try to zoom in a little here. What month do these different expenses start? So advertising, we said we're going to start that in month 1 of the model. Even though school doesn't start till month 8, we think we're going to have to advertise right off the bat because we need to get enrollment going, right? We need to advertise early. But then let's say maybe you don't get possession of the building. If this is a new facility, maybe you don't start paying utilities and insurance and whatnot until month 6. So we've got month 6 set up there. And then there's some of these expenses that won't start until school's in session. So like food and cleaning, you won't need to do until month 8. Then maybe rent. Maybe we negotiate with the landlord. Maybe we need a little time to get renovations done or remodeling, and so we're going to have to get access to the building in month 3, start paying rent in month 3. And so what you want to do with these operating expenses is you need to put in the expenses you expect in a normal full year. So even though we're saying, hey, in the first 8 months, like this example, okay, here we're saying food. Food we're not going to start paying until month 8. Well, we've said month 8 here, but you still want to put in what would be the monthly cost for each calendar month, okay? So go ahead and put that in, and the model is going to be smart and say, okay, even though it says $7,500 in January, it's not actually going to expense that because we're saying right here, in the first year, we're not starting this expense until month 8. But then in the second year, you will have expenses in January because you'll be in full operation. So you might have, and actually this is probably a good example, I should make the food expense in June and July in that normal year will be 0 because if there's school's not in session, that should be 0. So, but you'll probably have to, like for example, rent, you probably still have to pay rent, $12,000 a month, even though school's not in session. So some of those things will still happen. Maybe the cleaning cost goes down in the summer, but maybe you still do some cleaning, but it's less. So we can adjust that like that. Okay, so put in kind of, your average full year of expenses here. What would that look like? And then what it's going to do here is going to apply an annual increase or decrease. You could put a negative percentage here too if you wanted an expense to decrease over time. There's one more thing I wanted to show you. So this insurance expense is a good example that a lot of times it might just be paid kind of a once a year thing. And so just put that in the month that you expect that to happen. And then every year in August, the model is going to expense that insurance expense. All right, so then one more set of expenses down here, we're calling our scaling expenses. And these are where we have the ability to say, hey, this is other general and admin expenses, just kind of a catch-all, things we didn't catch up here. And we are going to say these are going to start in month 8, and we're going to select them as a percentage of revenue. And so we're going to assume that we're just going to spend 4% of revenue on just kind of miscellaneous other general and admin expenses. And then we're also going to spend on classroom supplies per FTE, so that would essentially be per full-time equivalent employee, we are assuming $250 as well. All right, now we're going to go to our salaries tab, and we're almost done. So the first thing we need to do, this is another tricky thing about schools and cash flow, is that a lot of times teachers will have different payment options. So they might be able to elect to get paid the same monthly amount even when school's not in session. So they could basically take their annual salary and evenly distribute it across the 12 months. And so that's this first option here. This is saying the payment period name is 12 months. So we're assuming that the teachers are going to get paid each month here, okay? Or really, I guess this isn't even necessarily the teachers, it's just going to be all employees. We'll get to select this for all employees. So even administrators or kitchen staff, that sort of thing, could all be included in this. So, okay, so then the next option is, hey, some of our employees are going to elect to only be paid during the school year, or we're only going to pay them during the school year. Maybe that's the kitchen staff. There's no students to feed. There's nothing for them to do for work, so they just don't get paid in June and July. And so you put an X here for January through May, and then August through December. But we have no X in June and July. That means they're not going to get paid. And then maybe you have some positions that are only paid during the summer, and so you can put in an X for those positions. Okay, so now when we're entering in each employee, so let's say we're going to have a principal, and the principal we're going to assume is paid evenly across the 12 months. They're paid $100,000 a year, and we can add in benefits, a start month, and an annual raise. And I've got classroom instructors down here, pre-populated. So we've got a teacher for the 3 to 6 class, and then 2 teachers for the 6 to 12 for the elementary school, and then a teacher's aide, additional teacher's aide for the age 3 to 6. And we have different payment periods. So we can say, hey, this teacher wants to be paid evenly over 12 months. This teacher elected to get paid, more, but only in the school year. So we have that ability. We can say what month that these employees are going to start. So we're going to start them all in month 8 when school actually starts. And then the one other thing I think we need to add here is, since we have food cost, we are assuming that we're feeding the children. So we're going to add kitchen staff. And let's say they are school year only. And let's say we have $25,000, 7.65%, and $5,000 in annual benefits, starting in month 8, because they won't need to work until the school starts. So starting in month 8, and let's say we have this right here. You can put in the number of the particular employee. So we're going to say we have 2 kitchen staff, each paid $25,000, and they're going to get a 5% raise. Okay. All right. Now we are done. So now if we come back to our at a glance tab, we can see what things look like. And we see that in the first year, it's only 1 semester. So that's part of the challenge here, is that you have some expenses that you're going to incur during that first year for the full year, like advertising up front, paying the principal ahead of time, because you got to have a principal in place maybe, or maybe you as the owner are serving as the principal, right? That probably makes a lot of sense, but you might want to be paying yourself a salary. So anyway, we can see a net loss here in the first year based on the numbers we put in. But then when we have a full year, 2024 and beyond, where we have 2 full semesters, you can see revenue gets up to $1 million and a 24% net income. It feels like a good healthy net income for this business. So you'll be able to then provide this income statement, cash flow and balance sheet to your lender or potential investor. They can take a look at that and play around with the assumptions as well. Make a copy for them, let them play around with it. All right, I think that is it. Now, I promised a discount code if you stuck around to the end of this. So if you go down to the description of the video below, there's going to be a link to a form. And on that form, you'll be able to fill out that form and put in your email. And then we're going to email you our most up-to-date coupon code for this template. And then you'll be able to use that coupon code at purchase to get your discount. So thank you for sticking around. I know there's a lot here. Also, if you have any questions as you go, please reach out to us, support@projectionhub.com, and we will do our best to help. Thank you.